Swiss like to say they're a small country of only 9 million.
There we go. All right. Welcome, welcome. All right. Really big morning, obviously. Jobs morning day. Massive deal right now. We are going to, at least expect the jobs report within the next 10 minutes and 30 seconds. However, there's apparently now a reported glitch with the Bureau of Labor Statistics where they are now experiencing technical difficulties and data reporting may be delayed. This comes at the same time as you've got Howard Lutnick playing overtime, purposefully trying to create news before Mike's crowd.
Okay. There we'll switch over. Oh, geez, Lord, lots of oopsie doopsies today. All right. So anyway, we'll use this. But you've got Howard Lutnick and the Trump administration running overtime to distract from this jobs report. And so not only are we hearing that this jobs report is potentially going to get delayed due to technical difficulties, it is potentially the case that we're not going to get a jobs report at all today because of these technical issues. Who knows? Maybe it'll be delayed a few minutes. Maybe it'll be delayed more than that. We don't really know. But what we do know is Howard Lutnick is working overtime, talking about their trade deal with Japan, how India needs to open up, how the customers always right, and because people are always going to come back to trade with America, we have all the cards. We have all the ability to negotiate and all the leverage, and the Supreme Court will eventually side with us when it comes to tariffs and the legality of tariffs. That's Howard Lutnick for you and his presentation so far this morning. This comes, by the way, at the same time as Elon Musk has released his next compensation package based on Master Plan 4, which could get him to 25% of an ownership stake and be worth well over $1 trillion if all of these milestones actually end up being accomplished. It would be a boon for not only Tesla, where Tesla shareholder deck suggests that $7.5 trillion of shareholder value would be created, but Elon Musk's compensation would be tied in 8 different tiers to various milestones and achievements along the way. So a lot going on this morning. Let's listen in for a moment to see what Lutnick is saying about this technical issue.
We're going to see a number in 10 minutes' time.
I don't know if we're going to see a number, but I tell you, it makes it crystal clear. They should have fired the person who was running that group, right? Because if they didn't fire him 2 weeks ago, they sure as heck would be firing him today. So they need new leadership in BLS. That's for sure. They need new tech in BLS. That's for sure. And Donald Trump needs to rely.
I think everybody knows that Donald Trump is willing to play dirty. And it just wouldn't surprise me to see some kind of gamesmanship over what's going on at the data. That somebody that Donald Trump put in this sort of position pull a plug accidentally on purpose, trip over a cable, trip over a wire. What's actually going on here, right? It's interesting, and we'll see. So kind of curious to see if we're going to end up getting our data. What is also very exciting is that today is, you already know, Bullish Catalyst coupon expiration day. And just to give you a quick little sample of our alpha report yesterday, this was just a part of it yesterday. We actually suggested literally in the pre-market that we would look for a bounce at 569, which is remarkable because if you bought the 569 and 3-cent bounce on the Qs, you would have been way up. Look at this. Not only would you have been way up from 569 to a closing price of 575, but you'd be paying attention to our next lines, 577, and look, literally riding my uptrend at 578. This at the same time as that pay package coming out for Tesla, leading Tesla to basically reject my line within 16 cents of the 347.58 line. Kind of incredible. So if you want these alpha reports every single day, the market is open. Make sure you join that Meet Kevin membership. We've got not only 10 stocks to buy over the next 10 years, with 3 of them released so far and the next 7 coming out soon, So you want to be a part of the fundamental analysis and the deeper analysis that we do into those when those come out, but also, of course, the alpha report on the daily basis. So with all that said, what do we got? What's going on with the BLS, the Bureau of Labor Statistics, still experiencing technical difficulties? We are looking for this unemployment read. We're looking for 75,000 jobs. I'll be satisfied with 50 plus, maybe even 40 plus. Somewhere in that range. Like, just give us something if you give us something that's somewhat soft, yields will keep coming down, and we won't end up in a situation of some kind of stagflationary fear hold where we end up with high interest rates for even longer. I think everybody's sick and tired of high interest rates. Like, we just want some
Bullish
bullish catalysts already. So hopefully we get that today. Let's take a peek at what's going on with yields. Yields this morning are down as the Bureau of Labor Statistics is experiencing technical difficulties. Yields are down about 4.2 basis points. We're now only at 4.13. 10-2 spread back at 57. 2-year Treasury yield now the lowest since April 7th, Liberation Day. So yields are tanking. This, by the way, at the same time as we don't even know if we're going to get the data on poverty.
But they haven't been increasing their hiring plans. At what point does that change? Or is this just a sort of sea change in the way the relationship between profits and employment? Well, when you think about it, companies has hired a lot over the last few years coming out of a pandemic. And right now, I think what's happening companies is trying to be more efficient. And that doesn't necessarily mean you need to increase headcount to do that. You can also use technology to do that. And some of that is coming through, particularly from the AI front. And that probably is going to continue. So I think the job creation's not looking for it to sort of fall off the cliff. But again, we're coming off from a very high level over the last few years. I think what you've seen in the labor market is some normalization as well. We think that corporate profit.
All right, we'll see. See what CNBC says as well when this data actually comes out. Okay, we'll wait for that to load. In the meantime, let's oh, there we go. In the meantime, let's go see what's going on in the sticks. So Tesla about 2 years, 3 years. We on that Elon Musk pay package. You've got a lot of green actually. If you look closely, you've got Bitcoin up at 112.6. You've got the Qs bouncing around 578. Really just broadly good movement on stocks. I've got Nvidia down about 1% on Nvidia. AMD's down about 2%, losing that 161 line. Unfortunately, a trend indicator that AMD might be trending back into that 140 range. Something we've talked about in the alpha report as well. Remember, coupon expiration day means pricing is going to go up at the end of the day today. It's 11:59 p.m. tonight. Remember, go meetkevin.com, learn more about it. But data is expected still within the next 2.5 minutes. We're unclear if we're going to get it, given the potential for Trump gamesmanship of the data. Just wouldn't surprise me at all that, all this data gets screwed up for the next few hours to purposefully get people uninterested in the labor report and think that, well, if they can't even get their technical, skills up and running, then how could their data be reliable? And again, I wouldn't put it past Trump to strategically assign someone to go trip on the cords, yoink the Ethernet cord out Friday morning, go conduct some saboteur stuff. It's going to be interesting. Let's see what Becky Quick has to say.
See, we are just a few minutes away from the government's July employment report. The futures ahead of this are a mixed picture. Dow's gotten a little weaker recently. It's down by about 135 points. NASDAQ futures up by 102. S&P futures are up by 2. Treasury is ahead of that number. We've seen yields a little weaker, and that continues with the 10-year at 4.13 and the 2-year at 3.56. Right now, we want to bring in our jobs panel. Our panel of experts. Steve Leisman's here. So is Rick Santel.
Yeah, Lulu, there are some of y'all asking about Lulu. No kidding. Well, Lulu smashed with terrible earnings. They are now down to 165. Look at this. This is just complete destruction over here. I mean, you're gonna open up somewhere where my mouse is over here, which is basically COVID lows is what we're at right now after Lulu, which is pretty remarkable to think that Lulu could fall this much. So we'll see. But anyway, labor market data due out now within the next 30 seconds. We'll see if we actually get it on time and who gets it. Remember, we're looking for 75. My take is really anything over 50, maybe even 40 is just going to be good enough where we price in an extra cut. And market's broadly happy. If we get something crazy like over 100,000, expect yields to spike rapidly, and we might actually start unpricing that cut. So even though we have Bureau of Labor Statistics technical issues, here we go. Expecting 75,000. 22. Oh, it's bad. 22. That's it. That's terrible. Oh my gosh, dude. No wonder Donald Trump yesterday is like, we're not going to get the real numbers until next year anyway. It's terrible. Prior revision is up 6,000. Non-farm payrolls up only 22,000 jobs. Private payrolls up 38,000. Change in manufacturing payrolls minus 12. Average hourly earnings stable at 0.3. Average hourly earnings year over year at 3.7 versus the 3.8 expected. Unemployment rate stays stable at 4.3%. Well, I'm sorry. That is up from 4.2% in the prior read. It is at expectations. Sorry, I misread that a little bit. With the labor force participation rate ticked up. Now, this is actually not great. Because what happens is as the labor force participation rate starts ticking up, you're going to end up seeing that unemployment rate move up very, very rapidly. And the move up in the unemployment rate is exactly the big issue that we're worried about. Because once we get back to a 0.5 percentage point increase, we're going to be right back to triggering the Sahm rule, and we're going to be right in the gutter of potential recession. Now, this should start moving rate cuts in favor of potentially even a 50 basis point cut. Looking at the bond market's reaction, 10-year yields presently at initial reaction almost down to 4.1%. This, by the way, this crash right here in yields, this is going to be huge for real estate. This is going to be really good for real estate. So let's take a peek at some of the actual data in the report. So we're just going to remove some of the highlighting that we had in the prior month here. There we go. Okay, total on-farm payroll changed little in August, just up 22,000, and has shown little change since April. The Bureau of Labor Statistics reported today the unemployment rate is 4.3, also changed a little. Remember, it is actually more than changed little. It is changed. The unemployment rate going up to 4.3% appears to be because of an increase in the labor force participation rate. If that labor force participation rate, which has been declining, really starts rallying again, we're really going to have some serious issues because we're going to be in a place of, I hate to say it, but poopy doopies. Where the unemployment rate rockets up. Okay, let's go and look at the households report because we know this had just 22. The households report is right here. So civilian labor force employed. Okay, so the household report moved up 288,000. So we got a positive read right here on the household report, as the participation rate did move up 0.1%. So our employment to population ratio stable, thanks probably to rounding here, but employed coming in at 288. But if we look at that payrolls level, we could see here just a 22,000 increase, little change. A job gain in healthcare was partially offset by losses in the federal government mining, quarrying, and oil and natural gas extraction. This news release presents statistics from 2 monthly surveys, the household and the payrolls. Both unemployment rate at 4.3 and the number of people unemployed, 7.4 million, changed little in August. Among major work groups, we've got, these are just unemployment rates amongst various different individuals here. Long term, we're 27 weeks unemployed, increased 385,000 over the year. That's not good. Labor force participation rate did increase. The average number of people employed part-time for economic reasons sits at 4.7 million. Let's see here. Healthcare added 31,000 jobs, below the average of 42,000 over the past 12 months. And employment continued to trend up in ambulatory care. Okay, fine. I'm going to get this to where we can highlight. Stand by just one here. Well, I mean, I know this is a bullish, like I didn't think coupon expiration day would be bullish catalyst for bonds, honestly, but turns out it's going to be bullish catalyst for bonds here. So we got, again, 31,000 jobs here in healthcare, below the average of 42 over the prior 12 months. You've got social assistance, which is basically government, up 16,000. But that was offset by federal government firings, down 15,000. Then you've got wholesale trade down 12,000, manufacturing down 12,000, and construction, retail, trade, transportation, warehousing, information, financial activities, professional business services, leisure, hospitality, and other were little changed. So basically, you're just not seeing any hiring. So when you're not seeing hiring, no hiring, any losses of jobs, like in manufacturing, are showing up immediately in weak job data. Okay. So, yeah, we're now pricing in a 3% chance of a 50 basis point cut. That's quite remarkable. Starting to price in those 50 BP cuts. Yikes. Okay. So let's see now for payroll. And again, the households report was good. Up 288,000 for the households report. So I feel like a little bit of a mixed bag here, because you could see in June to July, we ended up getting a crash in this households report where we lost about 200,000 jobs. And in August, we got those jobs back. So maybe something funky going on with the data there. But overall, this is definitely a weak headline number, not great. And if we take a look at the response of the market, oh, look at that. The market's actually up. Why? Well, probably because the market sees the Federal Reserve reacting substantially more rapidly to labor market weakness. Still technically not a negative number, and those private household numbers, rather, were pretty decent. Let's listen into CNBC just for a moment here.
Just sort of on the economy. Good sector overall, minus 25. Private education, healthcare, 46. And then one other number here, goods overall. I wanted to just check one other thing, which was the professional business services, minus 17. A lot of minus signs here is all I can tell you. I did want to check health.
Okay, it does also look like job growth, even though it was revised up in July by 6,000 jobs, June job growth was actually revised to a negative read of 13,000, which actually means we had 13,000 plus 73,000 plus the 6,000 add back in, and then plus 22,000 divided by 3. And that puts us about an average of 38,000 jobs per the last 3 months. That's actually a little bit better than the average that we've had previously. Just because we're probably so weighted down by a negative to get a positive 22 over the 14 that we had before that is actually somewhat useful. So when we look at this data, a couple things. First, bullish catalyst, number one, is that the household survey showed, let's go take a peek again. Household. Okay, here it is. Household survey gave us 288 jobs, 288,000 jobs, up 288K. The average 3 month after losing that low 14K is now 38K per month. This includes the June payrolls data turning negative, going down to going down negative 13,000, down 13,000, and includes upward revision to 79K on July's data. So clearly a weakening trend here. This should be plenty to confirm a 25 bipple cut. I'm going to take a look here. I mean, CNBC on screen here shows 100% chance of a first cut in September, 81% chance of October. If I go for looking at the economic activity myself, I see, yeah, 97.9% chance of that 25 BP cut in September. It's pretty much in the bag. By the end of the year, we're getting to about 2.5 cuts. Okay. And let's see here. Payroll figures came in on time, seemed to confirm the sense that the labor market is sort of in limbo. Job growth was below expectations, and with negative 21,000 revisions, we basically had zero employment growth. Now, that's also an interesting way to look at it, essentially zeroing out what we had here. Yields are sliding, good for bondholders. And then, of course, there are questions about complacency. You know, are markets complacent in the face of some of this data? Okay. 27-week unemployed ticked up as well. Let's take a look at the chart, though. St. Louis Fed, 27-week unemployed. Let's see here. Yeah, nice continuous uptick over here. You can see the 27-week unemployed number for July is out 1543, continuing that unfortunate uptrend that we're seeing. Here's Nick T's discussion. Although a lot of concern about that zeroing out. Private sector employment added 29,000 jobs. 6-month average is now 67,000. Yeah, and the 3-month average per month on a 3-month average is 38K. Per Nick T on a 6-month basis, we're at 67,000 jobs. And then remember that the payrolls revisions of minus 21K basically wipe out the positive 22K. Let's see what Rick's saying for a moment. He always seems angry.
Baseline for these numbers and the distortions that have happened since, whether it was because of injections of funds, the jump in inflation, we all know the issues. So if you look at an unemployment rate of 4.3, that isn't so bad when you look at it historically. Hours worked, even to 3.7, which is to me the most disturbing part of the data today on the average hourly earnings on a year-over-year basis. But that's still 0.3 higher than what we were doing the first couple of months of 2020. So the way I look at it is we've now become kind of a no hire, no fire economy. We're not seeing a huge amount of job creation. But to take that and think that we're going to put the economy in reverse and hit the gas, I don't think we're going there. So I think that the path that Fed Fund futures seem to be outlining with the 3 meetings are potentially hot for the following 2. We know SEP is for sure hot, and we can know the white noise may disappear. But ultimately, I think we're getting back to some sort of normal, and the market's going to have to grapple with, can the equity prices remain at these levels? Is the air too thin? There's going to be potentially some rejiggering in the economy, but I completely disagree with the notion that the labor market is really going to be suffering. I just think it's getting back to something more sustainable.
All right. I mean, that's an interesting point of view, this idea that, okay, we're going back to sort of a normal level or whatever. I mean, maybe, especially with participation rising, but the issue really comes down to a rise in participation likely leading to a substantial surge in the unemployment rate, which, I mean, that's a definition of, recessionary. So let's see what else here. Let's see. Unemployment rate, static. Okay, let's see. Fed perspective. How much growth can the economy squeeze from pretty much flat trajectory of labor growth is another question, right? Okay. So maybe take a peek at seeing at what else Nick T might be saying here this morning. Yeah, this is a pretty good miss to the downside. The economists really screwed up again on forecasting this one. Okay, let's break this down because there is a lot to break down. And let's talk about the impacts of this. And then we'll also, speculate a little bit on what this is going to mean broadly over the next 3 weeks. Okay, so let's get into it. Holy smokes, we have gotten a lot of news just this morning. We got to talk jobs. We got to talk Tesla and Elon Musk. We got to talk Broadcom with OpenAI making their own chips. Man, that's a slap in the face to NVIDIA and AMD. NVIDIA down 1.8%, AMD down 2.2% right now. Folks, we really need to talk, though, about this labor report. So yesterday, Donald Trump said, ignore the labor report tomorrow. And as soon as he said that, I started getting a little sus. I'm like, wait a sec. What do you mean, ignore the labor report tomorrow? Oh, the labor report's not going to matter until next year anyway. Did Donald Trump get a little heads up that today's labor numbers were going to come in below 79 out of 80 estimates? That's right, 79 out of 80 Wall Street estimates got it wrong. That's because even though I even lowered my standards for this report, okay? For the ADP report, I just wanted to see 60, even though markets were expecting 70, we got 54. Yesterday, I said, all right, look, markets are expecting 75 for this labor report. Let's just be ultra conservative and say, you know what? Give us anything better than 40. We couldn't even do that. We got 22,000 jobs created, which if we consider the revisions that we've had of negative basically 13,000, negative 21,000, bringing us to negative 13,000 for June, with, yes, an upward revision in July of about 6,000. We've basically wiped out any gains this month with revisions in prior months net to the downside. So it basically means annualized, our labor market is growing at 0. On a 3-month basis, we're growing at 38,000 jobs per month, which is great. And at a 6, it's certainly better than 0. And it's higher than the 3-month rate that we had in the last 3 months, which is good. We've had some pretty good lows in there. But the 6-month average employment rate is running at 67,000. And so clearly we could see this deterioration over the last few months. And this is why people are very worried that we might be walking into a labor market recession. Now, the stock market in the short term doesn't price in recession. The stock market in the short term doesn't work that way. The stock market in the short term tends to look for what I like to call bullish catalysts. This is exactly the game plan that I set up yesterday for all of y'all publicly. Mind you, yesterday evening, I made a video and I said, look, people love discounting data because things don't get real until things get real. This is exactly the same thing that we said in the Alpha report yesterday morning, which you could get if you're part of the Meet Kevin membership. Price goes up tonight at midnight. You pay once, you get lifetime access. But this is exactly what we said yesterday morning before the market was open. Before the market was even open, I suggested that this ADP data will probably be discounted by markets. I literally wrote, markets will probably discount ADP and Challenger data in favor of decent claim numbers. This suggests that Q's bounce today. I'd look for a bounce at 569 and play the upside. I don't see us crashing out. This was in the Alpha report yesterday. And what happened yesterday? Well, we literally bounced within 3 cents of where I suggested we might at 569 and 3 cents. And we were up from there all the way through to the 577 to 578 line now, where we sit in pre-market. Actually, we sit even above that now at 579. So why is the market reacting so positively? Well, it could be because the 3-month average employment rate did tick up a little bit. It could be because the household numbers are actually decent. They came in at positive 288,000. Remember the difference between the payrolls and the household survey. Payrolls survey is, hey, boss, how many workers do you have working for you this, today? Oh, I got 10 workers for me. Okay. Then you call the 10 workers. Hey, how many jobs you working right now? Oh, I got 2 jobs. Okay. Well, there's this potential that usually when we look at these reports, you double count in the payrolls data and not in the household data. That usually leaves people calling the payrolls data less accurate, the household data potentially more. Well, the household data here is good. So again, if you're looking for a bullish catalyst, the fact that you had a good household survey at positive 288,000, the 3-month trend taking up slightly, and the fact that we're basically now fully pricing in 25 basis points of cuts from the Fed explains why, just like we forecast yesterday, the markets are actually decently optimistic at the moment. They're not really caring about the fact that we could already be in a labor market recession. Markets don't think about that until it's too late. Markets panic when earnings start plummeting, but earnings don't really start plummeting until your neighbors lose their job and they can't find a new one. And that's actually where we could go to some forward-looking concerning data. And that has to do with the labor force participation rate. The labor force participation rate has fallen substantially as of late. It currently sits at 62.3, and that's a smidge up from 62.2. It's been on basically a straight decline. Now, the labor force participation rate is critical because it suggests that if for whatever reason, more people come back into the labor market, like retired people, for example, say, you know what, I'm out of money, or I don't want to go through my money or whatever, I need to go work. The labor force participation rate will skyrocket. The problem with the skyrocketing participation rate is it doesn't take a lot of a skyrocket in the participation rate to see the unemployment rate skyrocket. And it is definitionally the unemployment rate that the National Bureau of Economic Research will use to determine whether or not we are in a recession. And once we are declared to be in a recession, that is exactly how people get nervous about corporate earnings. Corporate earnings fall, corporations lay off even more, and then you are in a self-fulfilling AI-fueled recession. Now, GPT doesn't think that there's going to be any kind of AI recession because, after all, even though they say we're in a bubble, they say that they're spending the money in the best way possible. And even though we've heard this before, apparently OpenAI is now partnering with Broadcom to produce AI chips at the same time as Elon Musk gets a master plan for compensation plan, which could eventually pay him out over trillions of dollars should he meet all 8 of his milestones, which include generating over $7.5 trillion of shareholder value to be able to unlock roughly 25% total control of Tesla. So a total of 25% if Elon Musk meets all milestones. This is all relatively bullish catalyst. Bullish. This is bullish Tesla so far. And if you've been paying attention to Tesla, you know a critical line for Tesla is that 347.58 line. In fact, in pre-market, we literally perfectly bounced off of it. And within 15 cents may as well be perfect. At the same time, you have enthusiasm around OpenAI and software. You have enthusiasm around Tesla. You have enthusiasm around rate cuts. You also have enthusiasm about bond yields falling. Now, this is actually a really big deal for real estate, which we know Warren Buffett is starting to position for real estate. We know that HouseHack is positioning a lot for real estate, and we know we have an expiring coupon code today, which there are going to be a whole lot more lectures on not just real estate, but stock investing, property management, and of course, Trumponomics, tax benefits for 2025 to still use. But what's most important beyond this coupon code expiring today is that the 10-year treasury yield is absolutely tanking. And this is a sign that potentially we're at the start of TLT going to the moon. Now, this is not personalized financial advice to go invest into TLT. Who knows? Anything can change. But markets seem convinced the Federal Reserve is now going to take this labor market data and it's going to switch to a point of view that we don't need to be worried about stagflation or inflation. We actually need to be worried about deflation. Just a few days ago, I said that massive deflation is coming not only on YouTube, but also on X. You can see it. Follow me there at MeetKevin or at RealMeetKevin on Instagram. And I talk about how we are about to go into a deflationary cycle where prices actually plummet for things, which then, of course, you might think, well, that's wonderful. I want things to be cheaper. But things being cheaper is only good so long as you have a job or income. And the concern is that we are going to go through an AI-inspired unemployment recession. Markets are not going to price that in until it happens. Markets are solely going to price in enthusiasm around rate cuts and yields going down. In fact, smaller cap plays could be most to benefit from yields coming down, but also most at risk of going bankrupt should, well, let's just say the poopy doopies hit the fan. So be careful. Now, when it comes to these payroll numbers and Fed expectations, markets right now are pricing in essentially a full 25 basis point cut in September, but it's likely we are now pricing in an 8.8% chance of a 50 basis point cut September 17th. This number just updated right before my eyes. We've got basically 3 full cuts priced in for the year and an 8.8% chance the Federal Reserve is going to panic and cut rates by 50 basis points to support that weaker labor market. Now, Donald Trump and his team, they're running cover trying to discredit the Bureau of Labor Statistics. The Bureau of Labor Statistics had technical difficulties this morning, which I wouldn't put it past the Trump administration to somehow orchestrate. And even though the data came out on time, Howard Lutnick is running circles around tariff announcements, and even their boy Elon Musk is trying to gain favor with Donald Trump by getting people to talk about Elon Musk's pay package rather than what's actually happening in the underlying economy. And unfortunately, that's just the nature of the stock market, is the stock market is going to care about the very short term. And in the short term, all this means is rates and yields are coming down, and it's an opportunity potentially to borrow cheaper for companies or individuals and basically just YOLO it up to the moon. Now, is that the most sound thing to do? Well, everybody's got to make up their own mind. But let's put it this way. If the Federal Reserve does not act quickly, we will probably fall behind the curve of employment, and Jerome Powell's reputation will be true. Jerome Powell will end up being Mr. Too Late, and he'll end up with a recession on his hands, or, well, the next Fed chair will end up with a recession on their hands, and we're not going to be able to spend enough money to get our way out of it. That's my big concern, is that people are going to lose their jobs, and companies are just going to use AI to refill those positions. And if people leave, so be it. It's more earnings for those companies, which does make the stock market a unique hedge to some of this drama. But anyway, that's some of my take on what's going on with the jobs report, and then, of course, OpenAI and Tesla. I personally will give you a quick little spoiler on where my head is on Optimus. I really wish we were manufacturing 20 million cars a year. I know that is one of the milestones to get to that level, 20 million cars manufactured total, which is a little different than 20 million per year. But I think that Teslas are so great. I think they're such a great vehicle. I love my Cybertruck. I just moved, over 100 gallons of paint with the Cybertruck. I'm very, very excited about the vehicles that Tesla produces. But I am concerned that a move to Optimus is really going to be a move to a product that can't really carry weight. When you see robotics, you're almost always going to see them carry or operate with very lightweight objects because we just don't have the motor technology yet to keep doing heavy tasks on repeat for robots without breaking down. So I'm a little nervous about the master plan, but then again, I get it. Even though this master plan might not be exactly what I, would agree with, I have to say, Elon Musk has balls to put his compensation onto this master plan. So good for him. And I think that's why Tesla is up, because it's really a sign off on the optimism that Elon Musk has for Tesla. And who knows, maybe in just a matter of time, my optimism will switch from cars to robotaxis to Optimus. And we'll be right back to bulling for Tesla.
Bullish catalyst.
Bullish catalyst. For now, hopefully this is enough of a catalyst to actually break out of this 347 trap that Tesla has been open. Notice another stock that's also rallying heavy. We just yesterday hit all-time highs on Opendoor. Well, I should say recent highs, like last 12-month highs on Opendoor, and we're up another 7% in pre-market. You might wonder why a real estate play is moving up, and folks, it has everything to do with yields. In fact, we expect other real estate plays to be up as well, such as Pool, D.R. Horton, Lennar, Lowe's, Home Depot. All of them are green. Folks, why? Because mortgage rates are coming down, especially in the face of this weak jobs data. Look at Rocket Mortgage. And this is, again, why you want to be part of the Alpha Report. Spoiler alert, one of our 10 stocks to buy for the next 10 years is Rocket Mortgage. We've done fundamental analysis on this company in detail since it was $10. That's now over a double since then. And we've been very active in it on dips over the last few weeks, around $16 and $17. Even in our Alpha Report saying, hey, it's $17. It's a good opportunity to load up on Rocket. Boom, here it is, up to $20. We've got 9 other stocks to buy on the list, 10 stocks to buy over the next 10 years list. And I really encourage you to use that coupon code Bullish Catalyst and get in. So not only you're part of that daily technical analysis, but you're part of that longer term fundamental analysis as well. The real estate trend is happening, and I want you to hear it here first. Warren Buffett's in, you've got House Hack is in, you've got the lenders that are positioning. The only thing that is going to happen in the near term when it comes to any kind of recessionary scare is yields are going to fall. Now, what we may see is a spike in this 10-2 curve, especially since we have QCEW revisions coming up on the 9th, which is just in 4 days. In 4 days, we have another massive catalyst. And if we get a shock revision on jobs, something over 1 million negative in jobs, which is entirely possible, we could end up seeing the 10-2 spread rocket even more, and it does set us up for a recessionary environment. Obviously, everybody knocks on wood and hopes that we can avoid that sort of crisis because it's going to suck for people. That's just something to keep in mind. Now, something else to pay close attention to is what's going on with gold prices in reaction to this labor market report. Despite this labor market report coming in weak, gold prices actually moved up. Now, could that actually be logical? And the answer is yes. Typically, gold prices move up in anticipation of a crisis. However, gold prices tend to fall once you're in the crisis. So in other words, gold is a really good tool when you're driving towards a recession, but it's kind of a bad tool when you're in a recession. So are other risk assets. Everything tends to do poorly, with the exception of things that you can leverage very cheaply and safely, frequently like real estate. This is just an example where those who have jobs and those who have money will end up being able to make more money. Now, it's unfortunate for those who lose their jobs, but remember, even in a recession where the unemployment rate goes to 15%, you have to remember, even though that's really high, it still means 85% of people have their jobs. Very, very important. Now, bottom line out of all of this, there are 2 things that can really happen in the labor market right now, and both of them are just bad. Number 1, if the participation rate rises, the labor force participation rate rises, our unemployment rate will skyrocket immediately with it. Today, the participation rate rose 0.1%, and our unemployment rate went up from 4.2 to 4.3. This could just be the beginning, because if more people are coming off of the sidelines to look for work and join the labor market again, people who retired who say, I'm out, I need to go back to work, or people who were discouraged workers who at some point decided, you know what, I'm just not even going to look for work anymore, are now looking for work again, then the labor force participation rate will skyrocket, and we will very rapidly have a terrible unemployment rate. But it's not just that. It's not just people coming off the sidelines going back to work that could create a crisis for our unemployment rate. It is also layoffs, because our well, it's technically called the Beveridge curve, but it's written like Beveridge curve. Technically, the Beveridge curve is in a very abnormal state. We are in an environment of low vacancies and low unemployment. That's very abnormal. We're like a straight line on the chart when usually we have this sort of logarithmic curve down. And what that means is when we go back to a historically normal Beveridge curve, we're probably going to be at an unemployment rate of 10 to 15%. That's not to be bearish. It's just simply to tell you what the facts of history are. Now, how do you protect yourself in sort of this kind of environment? Well, there are a few different ways. Number one, for now, enjoy the rally because the stock market is almost always going to be blind to the longer term issues. That doesn't mean rush to the exits and sell everything now. It means set yourself a nice wide trailing stop. Maybe you set yourself a 10% trailing stop on some of your favorite stocks, or maybe even 7% on a big index, whatever. Nothing here is personalized financial advice, simply to say that if you want to make sure you're protected, set yourself up a blanket so you can soft land. Make sure that your trailing stops pay off your margin, pay off any short-term debt that you have, and give you enough cash to buy the dip and be prepared to hold out without a job for a good period of time, should you lose your job. Trailing stops are a fantastic tool for that, and you set them to be good to canceled. You only have to renew them that way every 60 to 90 days, depending on your broker. And this way, you can keep earning gains while limiting those losses. Really something to pay attention to. Now, again, why is the market so euphoric? Well, first, probably because coupon code Bullish Catalyst expires later today. And again, you get lifetime access to all the courses on building your wealth, the Alpha Report every morning. The market is open, fundamental analysis on the 10 stocks to buy over the next 10 years, all of that. Real estate insights, real estate analysis, you name it. Pay once, you get lifetime access. But markets, again, don't understand how to price anything other than falling earnings. Falling earnings mean it's too late. You're not ever going to see early recessionary pricing in the stock market. You will only ever see it in the bond market. Look at 10-year yields, down 10.2 basis points today, while the curve is still sitting at 60. That means the 2-year treasury is also falling in lockstep. It is. It's down over 11 basis points. And as they move in lockstep, you're not pricing in shock yet. You're pricing in Fed action. The odds that we are going to get a 50 basis point cut just during the recording of this segment right here have just now risen to 15.6%, which means we're really likely to see, especially when we get these QCEW revisions, a 50 BP cut, just like we did last September. And that's what the bond market is starting to price in right now. We're seeing the same thing, mind you, in some of the qualitative surveys. When we look at surveys, what are we finding? It's blatant. We're seeing a lot of inventory building, but we're seeing a lack of new orders. That means GDP looks like it's still strong, but it's really just inventory building so companies can get ahead of tariffs that are still taking effect. I just went to a flooring store yesterday and I'm told, dude, we went 5 months without any changes because of tariffs to our pricing because these companies had so much inventory. Now we're starting to get the letters that when this inventory is out, prices are going up. So all of that is to say that, yes, in the short term, yeah, we could still see some price hikes. That's fine. But massive deflation is going to come after that should the jobs market continue to grow this slowly, and I expect it will. So be prepared for all of that. Massive deflation is a good thing to the extent that you have a job and to the extent that you have capital to actually deploy. This is exactly why HouseHack is doing what it's doing. And remember, if you ever want to invest in HouseHack, you can always go to househack.com to learn more. Read the offering circular, read the private placement memorandum, and get familiar with the investment. Check it out over at househack.com. So with all of that said, we are now going to jump on over to our course member live stream. Thank you so very much for being here, and we'll see y'all in the next one. Good luck out there.